I'm going to dispense with the funny stories this morning because we've got a breaking story that's important to all of us. So we're going to talk about the new elephant in the room, and that is that Smithfield is closing the Sioux City plant as of April 20th. So most of you probably heard about that. The current capacity on that, they say 10,000 head. They've been up to 14,000 head in the last couple of years when they were shipping a lot of cut-up carcasses to China. They ended their second shift about 3 years ago, but they put it partially back on when that demand was in there, so they can kill 14,000. The plant, and I'm estimating here, I think it was built in the early 60s. There might be some people here that know when that was built. Anybody? I think it was built in the early 60s. It was relatively old, but far from the oldest in the country. The problem with that plant was it had limited processing. It was a kill-cut facility with not very much processing. Most of the hams and bellies went somewhere else for processing. It fit that China model pretty well, where they could ship half carcasses and quartered carcasses out. But as we know, that business is not quite as strong. The location is no longer a positive for Sioux City, without a doubt. As you drive in from the south, I don't think the city fathers in Sioux City really want the first thing you see to be a packing plant, and that is kind of what it is. And that's especially true without the stockyards. And this was completely foreseeable. We have talked about the pressure of costs and of mandatory country of origin labeling on pig supplies in the U.S. and the fact that it would probably cost us a packing plant. I thought after the December Hogs and Pigs report that we might have dodged the bullet for a year on losing a packing plant, because the December Hogs and Pigs report came in a little higher than where I thought it would be, with a Sepno pig crop that was larger than last year. But obviously the managers here are looking down the road, and they've decided to close the plant. Now, here's a little information. This is the U.S. capacity in the dark blue here. The fuchsia-colored line is the actual maximum weekly kill in U.S. plants. And notice that for a few years there, we would consistently kind of go beyond our rated capacity, and that's because the guy that was doing the capacity estimates, me, did not have all of the plants in my survey. Okay, so we could always run beyond it. I kind of had a fudge factor of about 10%. Then I kind of caught up on the number of plants that I was getting in my survey, and I've got most all of them now. And then this one right here was an outlier because of the huge run of pigs we had in the fall of 2007 after circovirus came along, and we had a bunch of pigs that lived to market weight that had been dying the last 2 or 3 years before that. Notice that last year was the first year in several in which capacity has been above the maximum week that we saw for the year. Now, probably a better measure is look at the average week for the year. And that's the pink line here. This is the average weekly slaughter for the entire year. Here's what happened in '98. And you can see that capacity is going one way and the number of hogs is going the other. And we had extremely low packer utilization in '97. In the summer of '98, Thornapple Valley closed at the same time that we were jacking up production, and it really caused some problems there in '99. But notice what's happened recently. We had been really increasing the capacity utilization rate for several years here, these two lines getting closer together, until last year. And it got farther apart. And it got farther apart because we cut back on output and we stopped bringing in so many Canadian pigs. And that puts pressure on packers. We had abysmal margins the first half of the year, and we'll show that in a little bit. The second half had kind of gotten better. But I think in this case, it's the Smithfield folks looking down the road and saying, man, we're going to have some real pressure here, and this is not, from a business standpoint and a value-adding standpoint, the best plant we have. Now, some folks would say, well, gee whiz, that Sioux Falls plant is older than dirt. And it is, but it's had a lot of money put in it, and it has value-adding capacity that Sioux City doesn't have. So I think that's really the deciding factor. Where are we going to be relative to capacity? Well, this is my forecast. The red is out of the December Hogs and Pigs report forecast for weekly slaughter, and notice we've been far short of that the first few weeks of this year, largely because of weather. Here is the new weekly capacity, assuming 5.4 days per week. We usually can run 5.4 days per week without putting much pressure on hog prices. If we get over that, we'll see more pressure on hog prices. It'll get a little tight in the fall, but we've been a lot tighter than that. So I'm not real concerned about this from a pricing standpoint, at least in the short run here. I just had a reporter on the phone said, are there going to be more? And my answer is no, I don't think so. This is kind of like a pressure relief situation. We've You get a lot of pressure on packing capacity. One plant closes and it reduces the pressure on everyone else. So unless we get some really larger changes in hog numbers, I don't see that this would be something that would come on. Impacts. One less plant is not the same as one less buyer or one less company. This is way different than if we had the only one of the companies that compete in the region close. Still many selling opportunities in South Dakota, Minnesota, Iowa, Nebraska area. You got 3 more Smithfield plants within driving distance, and from the announcement I heard, they're going to honor their marketing contracts. They'll take the pigs, as many as they can, to those plants. You've got other competitors close. The indication is that marketing contracts will be honored. The question there on freight, I think they'll have to do something there. I see a negligible price impact here in the short run. It's going to put some limits on where we can go long run with the size of this business, but we're going the other direction anyway, so I'm not sure that. We must be careful about output. I mean, it could be tight this fall, and if we jack up, don't keep liquidating sows and really push productivity the way we have been and get a much larger spring pig crop than what I expect, it could get very tight in the fall. Why did this happen? I think it's clearly cost and mandatory country of origin labeling are the 2 biggest things that are causing this to happen. It's not a surprise in the least. It's a little disappointing because I did think after December we might be able to avoid it. This closure is another step in what I've been talking about for a year on what the impact of this is going to be on rural America. I mean, for each million hogs that we reduce, 331 jobs in pork production, we know of those. We have neighbors on those. 680 jobs in pork processing. This is one of those steps right now. And then this 1,142 jobs in the rest of agriculture will be strung all over the place, and we probably won't ever see it very quickly. If we take 10 million head back, that's 21,000 jobs primarily, and I say in rural Americas, in this case a smaller city, but certainly it has some impacts on what's going on. Was there a question here? To paraphrase the Clinton campaign, it still costs, stupid. I mean, and I don't paraphrase the Clinton campaign very often, do I, Carl? No. Carl knows that, that's for sure. But it still costs. The big driver of what's going on here is an adjustment to cost. We might not have to do as much of it this year. Of course, corn usage for ethanol, 4.2 billion this year. If we look at the renewable fuel standard next year, it would require another 525 million bushels of corn to put us up here about 4.7. The rate of increase is slowing, but it's still increasing as far as corn usage. We have a record corn crop. Still some question marks about that. It might be part of it still in the field. I know there's a field right behind my house that's being quite efficiently harvested by about 30 deer right now. It's amazing. There were 4 of them in there, and within 2 weeks there were about 20. And I said, I don't know how they communicate, but word has got out in the deer world that there's corn. And so, but still we have this record corn crop, and yet we still have USDA average farm prices for the year forecasted about $3.50. If you look, we come off of the $4 mark a bit on the futures now, but still very, very close to $4. This new range of $3 to $4.25, we've moved into the top half of that during harvest. That's the 3rd year out of 4 that prices have increased during the harvest season. I think that's kind of an interesting thing that we need to note. If we look at hog production costs forecast through the end of 2010, this was as of last week. There'll be a little lower than this now as the futures market has sold off some more, but still in the $66 range on a carcass weight basis. That's been as high as $70 back in early December, late November. So we're coming down a bit, still about 26% higher than our historical average. Had we had costs based on history at this $52 and change level, we still wouldn't have lost money on a monthly basis in this hog market. Now, you know, you'd have lost money on a few hogs probably in November and December, or probably October and November, but we still wouldn't have lost money for an entire month during all this time. Now, the caveat on that is, had we had cost of $52.76, we would have had more hogs available right now, and those prices would have been lower. So I can't say that we would have just got through this scot-free, but still, we wouldn't have had losses of $20 and $23 per head on average for the last 2 years at the old cost levels. The relationship between corn and oil is strong. We're somewhere around 80 bucks. I know these, I couldn't get my internet to work last night. These numbers are a little bit high. I think we're down in the upper 70s now. But still, even with the upper 70s, we're suggesting corn prices in the 4 to 410 range. This is Omaha cash corn and crude oil prices, cash crude oil prices, Cushing, Oklahoma spot basis. And so there's the December 28th observation. We've been moving back toward that. Last summer, we kind of got apart from it. Before last summer, this thing had an R squared of 0.94, I think, 93. It explained about 93% of the variation that line did in this relationship. Now it's only about 70% because of these last summer, but we're certainly going back to that level. And what I've observed is that this relation holds a lot stronger at crude oil prices $70 and higher. Anytime you get below 70, the relationship kind of falls apart, but above that, they certainly hold strong. We have positive margins in the ethanol business. The blue area is above fixed costs here. They were very good back in October. They've declined some since then. But still, anytime this business has margin, it has slack capacity. And somebody's going to start saying, well, gee, we can make money over our fixed costs. We've got to pay the fixed cost anyway, right? And they're going to start producing more ethanol, driving up corn prices or driving down ethanol prices and arbitraging that away. I think this thing is going to bounce around this black line quite a lot in the next few years, just because we have plenty of ethanol plants out there. And here's some count on that. We have 193 plants operating. Interestingly, Harold, 3 years ago we were talking how many was going to be in operation at the end of 2009, and the numbers have come out almost precisely on that. 13 more plants still there, adding another 1.5 billion gallons. The current plants could use 4.66 billion bushels if they were operating full. They're going to use 4.2 this year. So obviously there's slack capacity there. If all those plants come on, they could use 5.2 billion. That means that you're never going to get very good profit margins in the ethanol business. It's slack capacity. It can be brought back online in a matter of weeks, and so I don't think margins are going to get out of hand. That also means that you don't have much downside potential for corn prices, because somebody will step in and start making ethanol and buying corn and arbitraging that market should it get cheap enough. We already have enough to exceed E10 for all U.S. gasoline, thus the push for higher inclusion rates. Now, I guess at this point the real important thing is, 3 years ago I had some hope of maybe changing this and avoiding some of this. That's gone. And it's gone because the plants are built and somebody's going to operate them. Texas A&M and FAPRI did this study last summer, and they took 5 different stochastic variables. They took 500 draws out of those distributions, computed the average prices for corn and ethanol and output of ethanol and all those kind of profits for ethanol manufacturers for 2011 through 2018. And here's what they come up with corn price. If we get rid of the blender's tax credit, it drops 0.6%. or less than 2 cents or 2.5 cents off the $4 corn. Okay? If we get rid of the tariff, it lowers it another 3%. If we get rid of the renewable fuel standard, it's 5.6%. Now these are alone. If you put them all together, there's some kind of additivity there. You would take about 50 cents off of $4 corn if you got rid of all of them. Okay? And the reason is the plants are there. They're going to be operated by someone. All of those Verisun plants that were in that bankruptcy last year, virtually all of them are up and running again now. Okay, because somebody bought them for 50 cents on the dollar, I guess it was Valero, and they can make money on them. So we still need an automatic RFS trigger. Now, one thing to point out here is these two expire at the end of 2010. And it's going to be interesting to see what happens there. I mean, the Congressional Budget Office has discovered this paper and done some work of their own, and they've said, okay, if we start collecting taxes on this, it doesn't make any difference on the price of corn, the price of ethanol, or how much ethanol we make. So why aren't we collecting taxes on it? Why do we still have a blender's tax credit if it doesn't make any difference anymore? Good question. I understand they're a little short on tax dollars in Washington these days. Okay, if I was in their shoes, I'd be doing the same thing. But there will be some political wrangling here. I think the sentiment, Chelsea, correct me if I'm wrong, but I think the sentiment is these probably will be allowed to expire. Is that what they're thinking? Yeah, come on, Chelsea. No. So I don't know. I've heard quite a bit of talk both ways, so we'll see. But they could expire, and that would help corn prices a bit, but it'd be pretty minor, maybe 3 or 4 or 5%, not a bunch. We still need an automatic renewable fuel standard triggered for that situation where we have a drought, especially if oil is cheap. I mean, we can shut down ethanol plants pretty quickly. It's hard to shut down the livestock business very quickly. And I make the argument that, and Harold, correct me if I'm wrong, ethanol refineries should be in favor of this because it would allow them to not make ethanol out of $6 or $7 corn. They should just be right with us. Please let us off the hook. Okay? Now, this decision, of course, right now stands with the administrator of the Environmental Protection Agency, and I've been running a running survey all fall and winter. How many in here believe that the administrator of the EPA will have the best interest of the U.S. livestock industry in mind when they make that decision? Okay, just raise your hands up there. Yep. Okay, it's still a shutout, so I'm going to skip through these. That's just economics crap. Okay. The point of that whole thing of drawings was that the only way to really solve this on a timely basis, the loss situation, was to reduce supplies. And we're in the process of that for all of the species. Chicken production last year was down 3%, turkey down 6%, pork production was down a short 2%. That would have been a 1% higher had pigs not been the size of small horses last summer. Beef production was down 2.7%. That would have been 1% higher had cattle not been the size of large horses last spring. Chicken reductions, I think, are slowing, and turkeys will also, I believe, just due to their reaction time. If we look at the year-over-year numbers on egg placements, they're about the same as they were a year ago, still lower than in 2008, but about the same as a year ago. Pork reduction will get larger. I've got question mark out there. I first wrote that before the December Hogs and Pigs report. Now I've got question marks beside it because it's not getting larger, at least in the short run. The beef production will probably not get any larger, but it will just take a lot longer. So what do we do about costs? Well, you guys are so tired of us telling you have to be more efficient, but you got to be efficient. And there are very high incentives. I think the growth of litter sizes has generally been the result of higher feed costs and the need to be more efficient. And the reason I think that is 20 years ago or 15 years ago when I started doing this, I would get asked, why aren't we as good as the Europeans and the Canadians at raising pigs out of sows? And the answer was, we didn't have to be. I mean, we had cheap feed and the Europeans had very expensive feed. They had to raise more pigs per sow in order to make money. And we just didn't have to be that good because we had cheap feed. Well, that's not the case anymore. And we're going to have to change our viewpoint. I mean, Irv, I think when you had corn at less than $2, you bought a lot of it, right? And you weren't too worried about leaving very much money on the table. Well, I think $3 is the new one on that. And if we ever get something with a 2 in front of it, as long as it's in a 2 and a 0, we ought to buy a lot of it. Ditto for meal, somewhere less than $300. I think it's going to be a pretty good buy opportunity in the future. Backward integrate into grain production. I think there are some folks that have done this. We've had a decade, 15 years of moving to specialization. This has taught us that diversification can have its benefits, and those producers that have had some feed production have probably weathered this better than others. Carry a strategic reserve. I've said this before. Some year we're going to get in a real pinch on corn supplies at the end of the season. And we saw a little taste of that this year in soybean meal. There was some real tight weeks in August of where do we find soybean meal as we tried to ration that supply out. And then we hit a late harvest on top of it that made it a little worse. I think you saw a little bit of that, and that's the thing you need to keep in mind on your feed supplies as we go forward. Okay. Domestic pork demand this year. It grew in 2009, but more important, the trends here are not good. If we look at all of these, our trend downward is slower than the others. It would look a lot worse if we didn't have this year as an up year, but meat demand in the United States is under some real pressure. And I think that's probably going to continue at least for a while. We have several issues. One of them is a political climate that is, in my opinion, definitely anti-meat and is trying to change the meat-eating habits of kids in schools and all of us that aren't in school anymore as well. I think we have a situation where demographics are working against us. I'm at the tail end of the baby boomer, and there's 85 million of us that are now reaching our mid-50s or older. And some of us ought to start eating a little less meat. But it's really good. It really is. I tell you what, sometimes meat can be great. I had a steak last night that was a good enough steak that it survived being cooked by an airline. Okay, it was pretty good, actually. It was not bad. They gave me an upgrade. It was really nice. So I was really surprised. But that demographic shift is major. I mean, my daughter has some friends that don't eat meat. They don't come to my house anymore, but they don't eat meat. And so that's more and more of a cultural thing that we have to deal with, and I don't think it's going to be very positive for us in the long run. Exports, 2 years ago, of course, we had a confluence of things, or as Bob Ross used to say on PBS, Joy of Painting, happy accidents. Record low U.S. dollar made us very competitive. The whole situation with China and the Olympics and their death losses in their hog herd, economic growth in other countries, a very strong Canadian dollar that made our product relatively less expensive. Now, factors 1 and 4 are in play again now, and that's positive for us in 2010. We do have a weak U.S. dollar that's probably going to get weaker, and a Canadian dollar that's very likely going to get stronger even from where it is now. If we look at monthly exports, of course, 2008 off the charts. I've likened that to your older, smarter brother that you're just never going to measure up to. Okay, so let's not try. Let's go back to 04 through 07. Here's the trend line, and if we extrapolate that out to 2009, we've been above it all but 3 months this year. November was the 6th largest month on record for U.S. pork exports. I think we're going very well in exports. Not a very good comparison to 08 when all those extenuating circumstances were present. USDA has its forecast to grow 10% 2010 versus 2009. I hope they're right. I think we're more going to be in the 6 or 8% range, but I wouldn't rule out 10% at all. That would be a big help as we go through this next year. In 09, those soft exports pulled hog demand down, even though domestic consumer demand went up. I mean, if we look at the demand for hogs, it's dependent on the domestic consumer demand, exports, and to a great degree byproduct values, and byproduct values were lower in 09 than they were in 08 as well. So both of those hurt hog demand. If we look at kind of frozen supplies, inventories on a supply side, we're in pretty good shape. This was a record drawdown during the fourth quarter of total meat and poultry supplies in the United States. A huge reduction of meat and poultry supplies. Of course, it was driven mainly by turkey. No surprise there. They're always big. But even for turkey, it was a record drawdown. Pork supplies keep coming down. They're back at their lowest level in about 2.5 years. Beef kind of rocks along. Chicken, of course, had these huge stocks back in 05 and 06, but they've got those much more in hand. I feel pretty good about where we are as far as frozen inventories as we go into the spring. Canadian pig supplies are down and dropping. For the year, we're going to be market hogs down almost 70% versus a year ago, and they're going to stay at about this 10,000 per week level, I believe. Feeder pigs were down 1/4 for this year versus last year and continuing to trend down. I don't see any reason that that's going to stop with the reduction that's happening there on their breeding herd. Sows and boars about unchanged. All Canadian market hogs down 31%. And it's no real surprise that this all changed in early 2008 prior to the full implementation of mandatory country of origin labeling in September of 2008. I mean, it was a driver. The much stronger Canadian dollar was a driver as well. All of those are going to be debated in this case before the World Trade Organization that Canada and Mexico have filed over mandatory country of origin labeling. It's going to be interesting to see how that comes out, because you have a lot of factors that impact these trade flows, just as we have when we've had some disputes with Canada in the past. September Hogs and Pigs report was about as expected. This is back in September, mind you. We were down 3.1% on the breeding herd, but from the get-go, I said, boy, I don't trust those farrowing numbers, because they were down 3.1 both of the coming quarters as well, and I knew that we had just had that breeding herd being bred during the coolest summer ever. And I thought, we're going to get more litters. And when I talked to producers, I heard of extremely good conception rates. And so their fill-in efforts were very effective, and I didn't expect that to hold. In addition, we had an increase in productivity, another 2% increase that left us down only 1.5% on the pig crop there in June through August. And then came the December hogs and pigs report, which was more of the same. Now, in this case, all of the market categories were down. They were a little higher than pre-report estimates were, though, so it was a little bit of a bearish report. But notice that the farrowings were much less down than was the breeding herd, which didn't surprise me a bit. And with the gain in, another 2.1% gain in litter size, a set-node pig crop that was bigger than a year ago. So in spite of cutting sows back, we keep shelling out the pigs. And so far, we haven't seen any slaughter rates that would question this. Now, the last 2 or 3 weeks, we say, man, we've been pretty short. Yeah, we have. And for the life of me, I can't figure out what we should have been the last 2 or 3 weeks, given the weather we've had. I think it's really a weather-driven thing. I think we'll catch up here as we go through late January and February. Growth of litter size, 2%, 2.15% over the last 8 quarters is a record pace, even faster than the structural change years of the mid-90s when we were really changing the nature of farms out there. That's not necessarily the case now. It's just growth of productivity. And you've seen this one before. I don't think we're going to be much lower in slaughter this year than we were a year ago. I've got it down 1.4%. We might take another 1% off of that for weights. And here's weights, of course, huge numbers last year. We're down now, and I know some of you are dealing with some corn quality problems that's driving this. I hear a lot from Michigan and Ohio of, they're having trouble finding corn that doesn't have toxin of some sort in it out there, it seems like. They're really fighting that pretty hard, and of course we have test weights here that are suggesting some lower energy value and hurting performance as well. The net result, 09 production was down about 1%. So far we're down 10% this year. Now, that's not going to last for very long. I think it's mainly weather-driven, but we'll have to see how it plays out here in the next few weeks. When you're down 10% on output, it really helps prices. Let's remember that concept, shall we? Okay? $70-some on the cutout value. We've had some real strength in hams and a very curious strength in spare ribs over the last few weeks. I mean, spare ribs not a big part of the carcass, but they're up $30 since the beginning of December. And normally, I don't do a lot of barbecuing spare ribs in December. I don't know exactly who's been doing that, or January for that matter. I can't build a big enough fire without burning the house down. So, the new Packer discipline has said that they've moved hog prices with basically with the cutout value since last fall. Once they got their margins, what am I doing here? Once they got their margins back in place in the second half of the year, they've certainly been very disciplined. We saw abysmal margins early, pretty good margins of late. And so that's one of the other reasons I'm a bit surprised about the Morrell announcement is I thought we were okay on margins and kind of gotten out of the woods on that. But I think the managers there are looking down the road on this decision as much as they are anything. Sow slaughter back below 70,000 a week. I think we're going to rock along in this 65,000 range, which will be significantly lower than a year ago, 2 years ago, but higher than a year ago. So we could be drawing the sow herd down for some time. It all depends. I think it's going to slow some because of what's going on in the futures market. We're down about 3.5%. The Canadians were down 4.5%. In October, that's probably going to be a little bigger number when their January numbers come out because of their buyout program. I still think, you can walk through the math here, we've got to cover this increase in productivity. We've got to cover these higher costs. I still think we need to be, the two combined herds down about 12% or 6.8 million. Canada's probably going to 1.2 million. We can probably stop here at 5.6, but that's still 250,000 sows fewer than what we have now, or we had in December. So I still think we need some more liquidation, and the futures market right now is certainly not very conducive to that. Why have we been so slow to react? Well, you want to be in the hog business. It's been good to you. That's what you do. That's what you know how to do. I talked to a banker a couple weeks ago. He said, you know, you don't know how many times I've asked producers, are you sure you want to do this? When they were putting up farms or their home or whatever to stay in the hog business. And they said, yeah, we want to. So it's kind of an all-in. Producers believed 2008 was the new reality. I think some did. It was a windfall. It was a passing thing, but some believed it was there. Producer equity was as high as it's ever been going into this. Now it's down about 80% since then. But what that means is you've got some staying power, and you can stand some losses for a while. Now many of you are kind of at the end of that, but still it was one of the reasons we haven't reacted. Another factor is a lot of producers sold for prices well above the spot market. And they did it through packer contracts tied to the futures market, or by hedging themselves, or having contracts that are tried to feed or have windows or whatever. So if you were in one of these two lines, you are significantly better off than the person who is in this line right here, which is based on cash marketing alone. Okay? So that makes a lot of difference in what's happened this time. And we've never seen those kind of differences for that long a time period, back as long as we've had mandatory price reporting data, and probably forever. I don't know that we've ever seen that kind of gains for that kind of period. The lean hog futures carrot is good again. This is futures as of last week. The average was 74.67. We now have two or three of these right around $80. I think the average would probably be more like 75, 76. It's there, and I think that's going to slow liquidation, no question. And the last point is, the blue line is average variable cost, and the fuchsia colored line is price. And this is for the average producer on Iowa State University records. That means that a lot of producers have an average variable cost lower than this. Okay? And if that's the case, economic theory says that anytime you can cover variable costs, you're going to keep producing, because any extra that you gain, you can pay on fixed costs, which you have to pay anyway. And so as long as we cover variable costs, we stay in production. And as bad as things have been, we've normally been able to cover variable costs. And that's really it in a nutshell of why we see producers sticking in this business. So my supply forecasts are shown here on the right, along with a few others, with Missouri's, Iowa State, LMIC. We're all pretty close. I've got it down less than some, a little more than LMIC, 1.4% for the year, a little more in the third quarter, a little less here early in the year. If we look at price forecasts, I forgot to change the date on this. This is 114. Of course, these are about $2 or $3 higher than that now. Here are my price forecasts, and there's the futures. Now, this is based on just a straight fundamental analysis of what do I think supplies are going to do and what I think demand is going to do. And obviously, whoever's trading futures contract are using some way different assumptions than I am. I don't know. I don't think they're using different supply assumptions. Most of us still base everything off the USDA Hogs and Pigs report. So I think they're assuming much stronger demand as we go through the summertime. To me, that's a hedging opportunity. And if you're not hedged, I'd be hedged on a pretty good chunk of them at that, especially given what I think the cash position most of you are facing right now. So what do you do to survive and prosper? Manage margin. Feed cost and hog prices, they're a match set. I think you've got to look at them that way all the time. Manage risk relative to your risk-bearing capacity. Right now, you probably don't have much risk-bearing capacity, many of you. So you need to be hedging. If in the future you may be able to take more on, cash is always a good risk-bearing thing. But I think a lot of folks are short of that. Most cannot afford to gamble right now, and obviously financial management, managing cash and credit are going to be very critical for the future. I have a friend that went to Harvard Business School, and I asked him, I said, well, what did you learn there? And he said, 3 lessons. Don't run out of cash, don't run out of cash, do not run out of cash. And I said, you spent a lot of money doing that. And he said, well, we learned a few other things, but that really is what it boiled down to. So, okay, what does all this mean for the future? Well, 2011 beyond, the U.S. animal protein sectors, not just the hog business, but all of us. The dairy business is in the throes of a huge contraction. Whoa, that really messed up, didn't it? Okay. I can fix that too, maybe. The dairy industry, they're all going to be smaller, and that's a logical, predictable consequence of policy decisions. I mean, this was something we could see a long time ago. Those of us who observe this industry and kind of understand what it needs to be done as far as the economics go. unfortunately, I don't think either our policymakers couldn't see that or they didn't care. Fewer processors needed. I wrote this last week. Probably will not lose a plant in 2010, but 2011 and on, okay. Obviously, that's changed this morning. Fewer suppliers. There's going to be some consolidation on the supplier side and the service provider side as well, be that veterinarians or whoever it might be, custom applicators for manure, truckers, whoever it might be. All of those will feel the pinch. We're going to be more scrutinized and regulated than we have in the past, especially on things of operational within the barns. I think the whole animal welfare thing is going to continue at a pretty good clip. We're going to be more dependent on international markets for growth. 96% of the world's population lives somewhere else, and I'll talk about some of those here in just a moment. When I look at domestic forces, unfortunately, I see them all being pretty much negative. The political climate certainly favors intervention and regulation. Now, that may have changed somewhat yesterday. I mean, with one Senate seat switching back to the Republican side, and now you don't have 60 votes in the Senate, a lot of things could change on that one Senate seat, and we have an election coming this fall that might change some of this too. But still, the sentiment's pretty in favor of intervention and regulation, especially after the terror attacks of 2001 and the economic meltdown of the last couple of years. Protectionism, I think that's cooling a bit now, and some of that is because of this little political shift somewhat back to the right we're seeing in Washington, but still it was pretty hot at the time of the election a year and a half ago. Political and cultural forces that are definitely anti-meat, diet, ethics, a lot of things like that. I talked about those a while ago. In my opinion, a cultural climate that elevates animals to the status of God. When I look at many of the groups that are supposing animal welfare, animal rights, I mean, they have all the earmarks of religion to me, and their gods are their animals. And gods are more important than people. You know, we've had a move in Washington recently to try to get some faith-based groups behind the HSUS message. And, you know, I find that interesting because when I read the Bible, I find that it's about people. That's kind of interesting. Economic downturn. What will spending patterns be when we come out of this thing on the other side? You know, for years and years, Americans were real good spenders and lousy savers. We've gotten to be a lot better savers and a little less spenders at the time when the economy needed us to spend money. Isn't that interesting? Will that stay? I think there will be some lessons that will probably stick out of this, and we might not have quite as high a propensity to consume as we have in the past. International issues, on the other hand, I see as mainly positive. A lot of people live somewhere else. We will remain a competitive supplier of fed beef, pork, and chicken to the world. Now, grass-fed beef, that's a different cat altogether, and we're not very competitive there, and we're not competitive in international markets for dairy products. But these three, we can play with anybody, and we'll continue to be that way. One of the reasons we'll continue to be that way is we'll stay a grain exporter. In all the growth of ethanol and everything, I don't think we're going to squeeze exports down so that we need to import grain. At one time, you know, we thought that could be a possibility. But the growth of yields, and the yields are helping, no question about it, we need to stay a grain exporter. And that's a key, because if we're a grain exporter, then our interior grain prices are the world price less transportation costs. If we become a grain importer, those automatically go to world price plus transportation costs. And then you're not competitive anymore. So it's a source of major competitiveness if we can remain a grain exporter. Major economies, China, India, Indonesia, are recovering faster and still growing. A cheaper U.S. dollar will make us ultra competitive, and I've got probability of near 1 on that. Okay? Now, I'm going to offer one caveat. All of the fundamentals say the U.S. dollar is going down. We threw trillions of them into the supply a year and a half ago. Okay? At first, they all sat in bank vaults, because the banks had to have them to shore up their capital positions. And since then, they've started to trickle out into the economy and be loaned and start feeding things, and we'll eventually see some inflationary pressure and a reduction in the value of the dollar. That's the fundamentals, all right? The only catch I see in this whole thing is everyone thinks that's going to happen. You know, and anytime when everyone thinks something's going to happen, I always get antsy about it. But I'm still in that camp because I look at the fundamentals and I can't see any other way that it could happen. Was there a hand back there? Well, I'll tell you what, when Washington cuts spending significantly, remember that time that Sam Walton danced down Wall Street in a hula skirt when his, no, you don't want me to do that. So, I'll believe that when I see it. Besides, the Republicans haven't been a very good party of smaller government for a long time, so I don't think they can claim that. By the way, I am a member of no organized political party. I am a Republican. Okay. Yes, Will Rogers said that about Democrats first back in the 20s. But I think it's more appropriate here, even though I think the Democrats are catching up with us on this deal. After the dust settles, there will be a viable, competitive U.S. Animal protein sector. They will not disappear. You know, the talk of how this was going to devastate the production sector, well, it's going to hurt, no question. There are people going to lose their farms and go out of the business, but there's going to still be a U.S. and Canadian pork industry, a U.S. Canadian beef industry, a very profitable, competitive U.S. chicken industry, a very competitive U.S. turkey industry. They will be smaller. The participants will have to be very good at what they do. You'll have many of your operational choices limited. I mean, we have some states that are not going to be able to use gestation crates. That's probably going to grow before it gets smaller. It's going to be interesting to see how the Ohio experiment with their Animal Care Commission works out. That we're all going to be watching that very closely, I think, for the next couple of years. U.S. consumers will be forced to pay more for animal proteins. I think that's coming late this year and into 2011. We're going to have record high retail prices probably across the board on proteins. And the reaction of consumers will be interesting. I got a feeling they're not going to blame the ethanol plants. They're probably going to stop with all of you and blame you for it.